Things with Bitcoin are going crazy right now since the halving. Right now, we're seeing a huge dip in Bitcoin miner revenues, which is leading to a dip in the amount of miners and terahashes that are securing the network, and a massive loss of profitability, which is causing the Bitcoin difficulty, which is required to mine, to go down. Now, some people see this as a good thing, some people see it as a bad thing. In terms of decentralization, it's really not a good thing, because when miners become unprofitable, they turn off their machines. And when they turn off their machines, it consolidates the power between different users and different people. So it can cause quite a stir. Now, this change has seen the mining difficulty drop by over 7.8% as of June 5th, reaching levels not seen since before the halving event in April. This marks the largest difficulty drop since the collapse of FTX all the way back in 2022. One analyst said miners' daily revenues have plummeted from $78 million pre-halving to $26 million currently. This downward adjustment in mining difficulty can benefit smaller miners and potentially lead to profit for mining farms. However, one of the most important participants in the Bitcoin network may have a reason to rejoice in the coming weeks, as power requirements to mine blocks fell. So this is good for smaller miners that don't have large pools, and that it's taking away some of the competition. It's decreasing the amount of hash rate that's actually securing the network. So depending on how you look at it, it could be a good thing or it could be a bad thing. Data tracked by Coin Wars show Bitcoin's mining difficulty slumped from 83.6 terahashes per second to 79.5 terahashes per second on June 5th, reaching levels previously seen in March, a month before the halving event. Now, a terahash measures how many hashes, or a digital guess for a calculation, per second a mining device, pool, or network can generate. Mining difficulty is adjusted every 2 weeks automatically and can either surge upwards or pare back. This is because of Bitcoin's inherent structure, which keeps miners in check by checking the speed of block generation, i.e. whether you are mining too slow or too fast, automatically giving it about 10 minutes per block to be mined and validated. That's one of the largest difficulty drops since FTX collapsed in 2022, which sent Bitcoin prices spiraling down more than 10% in a week. With the network hash rate experiencing this 7.8% drawdown, which is comparable to the FTX collapse, miners' profitability has seen a hit as the daily revenues dropped by over 60%, from 78 million all the way down to 26 million. Now, this is what happens typically after the halving, is it has to adjust the difficulty in order for miners to stay profitable. Not to mention, there's been a lot of miners that have been forced to sell to pay for their expenses to keep operating. So there's that. Mining difficulty has been declining since early May following the lower network hash rate, as some miners turned off their equipment in response to lower profitability. Let's stop there for a second. When you have lower profitability, obviously you have less of an incentive to run the network until it auto adjusts again. And when it auto adjusts downward, you can jump back in the pool. These fluctuations happen all the time, especially the most notable one is when China banned mining back in 2022, I believe it was. There was a huge shift in the network hash rate, which means smaller miners and smaller individuals and smaller pools were able to capitalize on that. But the downside is theoretically, when there's less hash rate going on, it potentially, some see that it could be less secure for the network. As we all know, miners are entities that utilize extensive computing power, and since the rewards dropped from 6.25 BTC, they basically have to sell all of the revenue that they got pre-halving to help fund their ongoing operations until this adjustment happens. Now, I talked about this in another video where it would be prudent for miners, in order to not have to sell the Bitcoin that they're earning via block rewards, and partner with someone like a VC that has cash to burn, but they would rather be compensated in terms of joining the pool, getting a percentage of the block rewards and directly paid in Bitcoin, and that way they wouldn't have to sell the Bitcoin to help pay for their ongoing operations. It would be sort of a trade that works both ways. And I think that as more VCs and more people are adopting this, I think that's going to be what happens. So there's obviously a huge consequence that comes with that, right? Miners were a major source of the Bitcoin selling pressure in June, with over $1 billion worth of BTC sold over 2 weeks, as prices range between $65,000 and $70,000 levels. Selling pressure from defunct Mt. Gox and a German government entity has since roiled markets further, with BTC dropping briefly to as low as $53,500 last week. As of filming this today, it's bounced and it's now at about $59,000. The Bitcoin hash rate and difficulty might fall even more during the North American summer months as miners curtail some of their operations. The lower competition may provide some reprieve to miners who are already facing a profit squeeze due to the halving event. Meanwhile, at current prices, only a few of the most popular mining machines remain profitable for users, creating a scenario that could mark a local bottom for BTC. So there's a couple things that I want to cover here. This happens all the time. First off is after every halving, miners tend to sell their Bitcoin in order to continue to fund their operations. There's tons of ebbs and flows that happen with this. But at the same time, that means that's an opportunity for them to bring on new money and new cash flow and new investors to kind of help offset this. At the same time, as we talked about, it actually lowers the difficulty of mining. So these people that particularly aren't making a lot of money, they can jump in and kind of fill the vacuum there where all the other miners are turning off their machines because their operations are so large, they become unprofitable to cover all their overhead. So in this case, being a smaller miner actually is your benefit, and you can actually make more money because your expenses are lower. Now, there's a trade-off here that most people like. I don't know, I'm kind of on the fence with it, but it's a trade-off of, you know, when you get these large conglomerates and these large corporations that are mining farms, if you will, that sort of centralizes the entire mining infrastructure. I would rather actually have a democratic system in the sense that if we have more miners, it decentralizes the network even more, as opposed to having so many large pools that are mining all the blocks, right? So when you have all these huge conglomerates sucking up all these pools or having more hash rate because they can afford the electricity, they can afford the ASICs, they can afford all of these different things, I think it's important that we find a way to make sure that more miners can actually join and at least break even, if not become profitable. Now, we're seeing right now a situation where this is actually happening, where miners that are smaller or smaller pools or smaller individuals are jumping in as these larger conglomerates are shutting down their machines because they can't remain profitable. I mean, this is the free market at work. If it's not profitable, you're not going to do it. And if it is profitable, you're going to jump in and do it. So it's always the most efficient system that we have right now. But I want to find a way to have more miners encouraged to mine on a more regular basis, distribute the block reward, and incentivize more people to set up more nodes so it reduces the centralization that is a potential threat that could happen in the future. Now, I think there won't be an inherent flaw or an inherent risk of that happening anytime in the near future, but if it becomes increasingly unprofitable for big miners, then there's a twofold effect. One, it gives opportunity for smaller miners, which is good. You could actually get more people jumping in, but the difficulty automatically adjusts depending on how much mining activity that there is. So there'll always be a way to make sure that the difficulty in the hash and all of those expenses and things will kind of self-correct and auto-adjust, but I'm leaning towards I would rather have basically more miners in a way for that to become profitable, and may the most efficient person win. I think that the overall industry is going to be a lot more healthy, not to mention more secure from a decentralization standpoint. The more miners we have, the less of an impact that government entities can shut down mining farms, cut off their electricity, and so on and so forth. So I think the more that we have all over the world, not just in the US, but I think that more mining operations that we have in every area of the world is going to benefit the network of the whole, as opposed to just benefiting one region or one entity. Overall, I wouldn't be too worried about this. Having over a 50% drop happened back in 2016 as well, and there was also a dip, just not that big, back in 2020. But as the block rewards continue to get smaller and smaller as they are on clockwork after every 4 years, we're going to start to see massive shifts in the industry and miners to find more efficient way from an energy standpoint to do it. Now switching to nuclear, hydrothermal, hydroelectric, volcanic, all these different forms of energy that can ultimately make it easier for people to mine and be more creative and find more ways to do it. So let me know what you guys think. Are you worried about the Bitcoin mining hash rate dropping? Are you worried about the centralization of mining farms? And more importantly, are you worried about all these miners dumping their Bitcoin and suppressing the price when we're all ready for this bull market to continue on? I just wanted to kind of hop on a report and let you know what's been happening, kind of give you my take on it. But to me, I'm not worried. This is something that happens every 4 years. I've already been through 2 of these. For me, this is just a regular occurrence, I guess, something that I've come to expect with all the ebbs and flows of the market. It just happens to be hurting more right now than ever because we have a triple whammy. We have the Mt. Gox repayments happening. We have the German government just offloading all these Bitcoins that they stole from torrent sites, having the difficulty adjusted and having the block rewards, and them selling a bunch of Bitcoin to stay in business. Sort of this perfect storm of events that are happening. So let me know what you guys think. And if you guys don't want to wait to watch my next video, click on the one on the screen right here. Until next time, I'll see you guys in the next video. Crypto Renegade out.